接下来进行全体大会。
Now, plenary session number 4. It's about global economic governance and financial opening and financial cooperation. Now I'd like to invite Director of PBCSF Research Institute, Mr. Chen Weidong, to moderate this session.
老师们、同学们，大家上午好！欢迎大家参加2022清华五道口全球金融论坛。由于疫情原因，本届论坛采用线下线上相结合的方式主办。欢迎来到现场的嘉宾和在线上收看直播的各位朋友。今天到现场参加这个环节论坛的演讲嘉宾有国家外汇管理局副局长宣长文先生，中国社会科学院世界经济与政治研究所所长张汝燕先生，线上出席今天论坛的嘉宾有清华大学国家金融研究院院长、国际货币基金组织原副总裁朱明先生，2001年诺贝尔经济学奖得主 Michael Spence 先生，清华大学苏世民副院院长谢兰先生，欢迎各位的莅临。当今全球正在迎来百年未有之大变局，东西力量对比正在发生变化，全球化、多极化、民粹化共存，疫情大流行，一国难以独善其身。气候变暖引起极端天气频发，急需各国采取有效行动。由于俄乌冲突引发的地缘政治博弈，让我们看到了二战后国际金融体系构筑的安全屏障面临的挑战。
The post-World War II architecture of governance, hence the need for a new multilateral governance architecture and system to push for peace and progress of the world. Now we will focus on global economic governance, financial opening, and financial cooperation.
合作展开讨论。本届论坛由清华大学主办，清华大学五道口金融学院、清华大学国家治理与全球治理。
The Institute for National Governance and Global Governance with the strategic partner of BOC and official media of Tsinghua Financial Review and WeiYang.gx.com. With co-organizers of NIFA and TUFA. Now let's kick off the session. First, I would like to invite Chair of NIFA and former Deputy Managing Director of IMF, Dr. Zhu Min, to have a dialogue with Nobel Laureate in Economics 2001, Mr. Michael Spence.
Everyone to this financial forum hosted by Tsinghua Wudaokou and at the Tsinghua University. And in this session, we are very honored and privileged to invite Professor Michael Spencer to have a conversation with us. Michael is no stranger. I don't think he needs any introductions because people know him and he attended our forum several times already. And he currently is a professor at the New York University. And I say mostly people know him, and he won the Nobel Prize and on his growth theory. Also, one of the most important things is he chaired the Global Growth Committee right before the global financial crisis, which is a very important global initiative to review the growth framework and the growth theory and provide a very important policy recommendation as well. And Michael also very active on various issues on not only in growth, but also on theoretical economics, on today on inequalities, on environmental, climate change, and all those issues. He comes to China quite often. I remember, Michael, you many years ago, right? And when even I was in Bank of China at the time, yeah. So warmly welcome, Michael, you once again, and thank you very much coming to this forum once again to share your wisdom with our audience. Now, we are in such, and dramatically changing world, right? It's a very dramatic time today. I think we have a lot of things we can talk. But recently, you wrote a very interesting piece. You mentioned classical economics series, Lewis' Turning Point. You say, globally, because labor supply reached its peak, so the whole world is at Lewis' turning point. In that sense, we don't have any cheap labor supply anymore. We don't have any inaccessible production capacity as well. So in that sense, the growth will slow down, and we move into the new phase you call the regime change, right? And we have to improve our productivities to bring to the new growth stage. Can you explain your theory more to us? And because, you emphasize a global. I recall in China, we reached the Lewis turning point around 2010, right? Because the labor supply peaked at that time. And we observed indeed the growth slow down exactly that year. And we are also going to have a whole population growth approach to zero now. So, which will impact the growth once again. So, please, I think this is a very important piece of work and for the whole world. Yes, please explain a little more to us.
Well, thank you, Min, and thank you for having me. I wish I were there with you in person, but I've got my fingers crossed that we'll be able to do that soon, because I miss my visits to China and seeing friends, especially you and Jason and others. So, those of you in China are very familiar with this concept. The growth in the early stages of very high growth, is very substantially supported by bringing, underutilized productive resources, and namely labor, into the modern economy, where they join, an export sector initially, and then eventually a large and growing domestic economy. And a lot of the productivity gains, come from just moving people from low productivity, on average, low productivity environments into higher productivity ones. And that process, works beautifully until you start to exhaust the supply of underutilized labor, which is what the Lewis model was all about, and why it's been such an important part of the framework for thinking about the growth dynamics in China. And once you reach that point, it doesn't happen instantly, as all of you and your colleagues know, but you start to lose the force of that particular growth dynamic. And then the growth dynamic that takes over is, much more broad-based productivity gains across the entire economy. And China's an excellent example of having made that transition well. And there is some growth slowdown associated with that, but it's not dramatic, and the Chinese growth rates have been, impressive for a long period of time. What my hypothesis, and this requires more, serious work and some, work with data and so on. But when you look at the global economy as a whole, two things strike me immediately. First, we went from sort of demand-constrained growth for a decade after the great financial crisis, all of a sudden, very quickly, into supply-constrained growth. Some of this is associated with, imbalances and congestion in the global supply chains, and some of it's residual, COVID overhangs and blockages. But fundamentally, I think we've shifted so that our growth will be constrained by the extent to which we can increase productivity and growth the supply side. and then you look at the big picture. So what's happened over 30 years, Min, is that we don't have that much surplus labor left, and there are questions about the scalability, the speed of the scalability of what we have. But we also have a much bigger global economy with millions, tens of millions of new middle class consumers. And so when you go back and look at that 30-year process, we had essentially a kind of deflationary force operating because we kept bringing underutilized productive capacity into the global economy. And so anytime there was sort of, some sense that you might get, supply side constraints, they were relaxed immediately, at least in the tradable side of the economy. And so my hypothesis is that period's largely over. That, the vast majority of people in what used to be called developing countries and now are called emerging economies are middle class consumers, And so the demand side has grown enormously, and the supply side capacity to keep up that, flow of kind of low cost supply of goods and services, which are now tradable, is nowhere near what it was at the peak of that period. So my hypothesis is this is a kind of regime change. We're going to live in a global economy that's aging, that has less surplus labor and underutilized capacity to bring on. We will have growth that depends on productivity gains. I think the best chance for that at the moment, among, there are several, but it would be a digital transformation. And we're going to have inflationary pressures that we haven't seen for a long, long time. And this, I think, is important, and we may want to talk further about it. And that is, what I'm talking about now, and some other things that are going on in the inflation story, these are not transitory at all. This is a kind of secular shift.
Wow. But let me clarify first. You mean it's a global? So you don't think there are, sort of labor, unlimited labor supply, for example, in India, for example, in Africa, we can bring them into the global system. You don't think so?
No, I think we can. But then the question is it going to happen fast enough and at a scale that would reproduce the effect of, the major East Asian economies, but especially China, on the global economy? Now, this is a judgment call. I could turn out to be wrong on this. But if you were placing bets, man, would you bet that there would be a sudden surge of productive capacity coming out of Africa, of the type that you saw, in China? Maybe. I mean, it would be nice. It'd be good for their growth story, but I guess I don't see it happening. On India, India has a somewhat, by East Asian standards, a somewhat idiosyncratic sort of set of growth patterns. And so there is India is a potential source of incremental productive capacity. But to me, it looks like they're sort of taking a kind of different route. But we could spend more time on that.
Right. No, that's very interesting because the whole thing is when China reaches Louis' turning point, right? So the cheap labor support-driven growth model is almost gone unless you can find other surplus labor to fill the gap, right?
That's right.
Unless the production capacities. But today, look around, it's not easy. And it may have some potential, but it's not easy. So to support the global growth, and particularly on the productivity growth, it looks like we need two things. One thing is for the middle income countries, we need a shift to productivity-based growth, right? And for the other remain in the low income and also developing countries, we need to find whether we will be able to bring the technologies, bring in the capacities to absorb the remaining labor force, right? So that's become a two issue. But in the middle and the income countries, for example, like China, how can those countries move into productivity-based growth model?
Well, I think, I mean, there's a long-winded answer to that, but the answer is essentially what is going on in China. So China has become a major source of, technological innovation in multiple sectors. It is a major investor in human capital to support the deployment of those technologies. There's a kind of global explosion of entrepreneurial activity, particularly in the digital area. And China is an extremely important, prominent part of that. I mean, if you measure this by the production of unicorns, there's this private companies with a valuation of $1 billion or more. The largest source of that is the U.S. still. The second largest source by a considerable margin is China. And so the aggregate impact of all of that activity, I think, bodes very well for productivity growth over a wide range of sectors, including domestic service sectors. So I'm not trying to dismiss the challenges that I know you and your colleagues talk about, like debt overhangs and real estate things and so on, and global tensions. But I think the fundamentals of a sort of a very dynamic economy that will produce, productivity gains that will enable the transition to a high-income economy in the relatively near future are pretty much in place. You can find other countries where the digital transformation is underway, but the mass of investment in things that drive productivity in the long run, particularly human capital, is nowhere near what China's been able to achieve. So I'm pretty optimistic about that. But I think those are the fundamentals.
No, I think that's great. Thank you. But with your experience and also with your theory, with your framework, when an economy moving away from the cheap labor-driven growth model to a productivity-based growth model, does that mean the growth rate will slow down? I mean, because, for example, moving from manufacturing to service is not easy because service productivity is obviously lower than manufacturing as well. And when they close to the frontier of the whole world, improve the productivity become more challenging. Why? Think about 40 years ago, we are way away from productivity frontier, right? But the job. So
I know you're much closer now.
Yeah,
I think you're right. I mean, there's two things that happen, and they're both important. I mean, China's at the frontier in some sectors, already, including a number of the digital parts. So yeah. Then if you look at, I mean, I think the way I think about it, Min, is if you look at the advanced countries and ask how fast do they grow on average, because they're basically growing on the model we're talking about, right? You don't get long-term growth if you don't have productivity growth, unless the labor force is increasing, right? But let's discount that for the moment. And that, those numbers run in the kind of, even in an optimistic version, 3% range. So China's still well above that, but you're converging, right, in growth rates to what is sustainable for advanced countries. And if you look at the data, it's not like a steady flow. You get surges of productivity growth when you have a big, powerful general purpose technology like some of the digital ones, and then it levels off, and then you get another surge. So it's not a kind of steady flow. But on average, I mean, I think that, when you average it out over, decade type periods, you get a pattern like that. I mean, right now in the world, you see a declining pattern of productivity. And there's a big important question coming up, which is whether we have enough of the kind of technological tools to reverse that pattern. I mean, people have different opinions about that. I'm an optimist. I think the digital technologies, once they're widely deployed, have the potential to produce another productivity surge. But that remains to be seen. And that will, of course, occur in China as well. I mean, because of China's prominence in in building and deploying and adapting and adopting these technologies. The pandemic has produced a surge because we had to rely on the digital technologies in order to. So bottom line is, you're right. You get a slowdown in part because the structure changes and you're building lower productivity sectors on average, and you're slowing down because you're getting near the frontier and you're starting to grow at rates that are characteristic of advanced countries.
Right, and so when you move to the productivity-based growth, really, as you mentioned, I think it's very important. Invest in technology. You firmly believe technology will nurture the future productivity. So I think that's key issues. Invest in the infrastructure. I mean, I call the new infrastructure, not the previous road and the ports. And also invest in people, human capital. That's the three key issues. Anything else?
No, it's color commentary. I mean, I mentioned before this global outbreak of or explosion of entrepreneurial activity. This has been essentially. There's a more complicated version of the story, but the simple part of the story is, the mobile internet has expanded to about 6.5 billion people around the world, and it is that underpins the kind of platform. I'm using the word loosely. I don't mean platform as in Alibaba or JD.com, but it's the platform on which this kind of surge of digital innovation in serving consumers in goods and services is occurring. So that's a particularly important element of the infrastructure, but that's just color commentary. I mean, I guess what I'm saying is you can build too many bridges and not enough digital capacity, or vice versa. But so the balance matters, but it's still infrastructure. So it's infrastructure and markets. Let me say, the India story is really interesting in this respect. India was lagging in the mobile internet for two reasons. One, the supply side was fragmented, and while where there were several million Indians on the thing, the data costs, the streaming data costs were way too high, and because of the Reliance Jio investments, they went from some of the highest data rates to some of the lowest data rates in a matter of 5 years, and it's produced explosive growth in the mobile internet users, and that again has created a platform on which their sort of digital innovation system is starting to grow and beginning to look a little bit like China's.
So the entrepreneurship is also very important, right? Building the policy framework, building the business environment to support the entrepreneurship and innovation of a business model, also important to support the productivity growth. I think this is a very important point. And so to conclude this part of the discussion, this is really fascinating. It's a big picture. So as you mentioned when you did your just opening remark, you say we're moving from demand-constrained growth model to supply-constrained growth model. That means we need more structural reform at the policy levels, and we need a supply-side policy and reform as well, right?
Yep. Yes. No question.
Yeah. Not just like a new, near or old or whatever Keynesianism to support aggregate demand. I think that's an absolutely important point. Yeah, I think the good news in China, we started supply-side reform a few years ago. So
yes, you did.
Yeah, we realized things change. I think it's also important. But in your talk, you also mentioned when you exhaust the unlimited labor force, the wages will increase, which will bring in the inflation pressure. Can you explain that a little more?
Yeah, so this is the thing that Sir Arthur Lewis worried about. So he thought this early stage growth model was just fine in terms of producing growth. But as long as you have a large pool of people who have not made the transition, to the kind of urban modern economy, which is a multi-decade process, then the mere fact that they're there holds the wage growth down. So you're getting productivity growth and in the economy, but wages and incomes aren't keeping up with it for a period of time. And so, yes, and then at the Lewis turning point, you start to get more broad-based increases in wages because there isn't as much competition sort of standing there in the wings. Lewis worried about that because he thought, you'd get growth with most of the returns for growth going to the owners of capital, right? And not the labor, even though you were generating a lot of employment. But he also saw that was not a permanent condition. If you translate that to the sort of modern context, I mean, yes, I think, this is one aspect of why we're going to see a reversal in the pattern of declining shares of income in national income, which is, labor income. It's not the only factor. I mean, at least in the West, there's a sort of growing body of evidence that isn't really completely understood, which suggests that labor market behavior on the supply side by people, individuals and families is starting to change. There's names for this, like the Great Resignation. We have way more turnover than we're used to. People are retiring earlier than we expected, and so on. So there's other factors that, we're going to have to learn about over time. But the bottom line is, yes, I think that labor share is going to rise because of market conditions. Labor power will increase relative to where it's been. And at least in the developed countries, labor lost a lot of power because there was always the option of going and producing somewhere else if they made too much noise. So I think that pattern is also reducing, and probably this at least paints a different picture with respect to inflation. I mean, you know this very well from your work in banking and at the IMF and so on. We've gone through probably almost 3 decades, in which, at least in the developed countries, inflation, basically hasn't showed, since Volcker, we really haven't had any significant inflationary pressure, even, with what look like relatively tight labor markets and so on. Now, I think that's about to change.
So
is changing.
Low inflation is over.
That source, I think
fundamentally
so.
because of wages and will increase. So I think you made a very interesting point. The point is, it's not a good or bad because wage increase will be more middle income or bring in more aggregate demand. But only thing is we just get into the regime. It's a new picture. So you have to understand it's different from previous pictures. We'll move on now. No, but
and I think you will see this in China.
Right.
You're pretty near the peak of the population, and the population pyramid looks pretty aging like the rest of us.
Yeah.
So, there's going to be a lot of demand for those younger workers.
Yeah. On top of that, you really, really dig into a deep and fundamental issue. Say, hey, the global economic fundamental is shifting. I think that's very important. So at the top of that, we have all those volatilities, all those Ukraine crisis, all the others. And are you concerned about inflation will go further? Do you think we'll get into the stagnation situations in the next few years?
I don't think it's the most likely outcome, but it's definitely a risk. So let me maybe take Europe and North America separately. So in Europe, I think this European Central Bank is not yet forecasting a recession. I think they're hoping they can avoid it. They're not going to slam on the brakes in terms of monetary policy. So I think my own view is that's a bit optimistic, and we might very well have a recession in conjunction with relatively high inflation, because we had high inflation before. Now we have, a huge boost in inflation associated with energy prices globally, but they're, prominently affecting Europe, where we import the vast majority of the fossil fuels we use. And you look at the inflation figures now, and the majority of major European countries are up, at 6% or over. Now, this could subside quickly, but I don't think there's any real evidence that that's likely. You see a similar pattern in the United States, but it's more muted because the energy prices are having a slightly lower effect. But so I think, the best guess as to the future on this is that central banks will, who are kind of behind the curve and, getting on top of inflation, are going to try to find a middle ground. They're going to try not to slam on the brakes, which would produce a kind of stagflation sort of scenario. But they can't sit there and let inflation get out of control and inflation expectations get embedded. And so, I wouldn't want their job. I mean, that's a pretty tough job. That's a pretty tough thing to kind of pull off. So they may be forced to produce a pretty big economic slowdown because of the inflationary pressures. And then whether we call that stagflation, which to me has a kind of longer term connotation, or just a kind of a major jolt of the type that Volcker delivered when we really did have embedded inflation, at least in the United States.
Oh, the key issue is you just mentioned central banks are behind the curve, right? And the Fed really hesitate too much. They always say it's a transitory. Although I think you and me always disagree. Earlier days, it's not transitory, it's a permanent, so we saw that. But Fed is, I think everybody are concerned the Fed will take a very strong action because in the US, the Europe is 6%, Europe is 8 to 9% now. And the strong, usually shrink the balance sheets, temporary plus interest rates increasing to curb the inflation, which will cause the growth dramatically slow down. I think that's a real concern. But on the other end, I think because the central bank is behind the curves, it's very difficult for them to take action because this Ukraine crisis created another new situation, right? The military expenditure is increasing. You see that, right? And also security, and expenditures increasing. And the food prices increasing, energy prices increasing. And the companies think about sort of resetting, right? Based on the security, not also on the stability, right? Not on the maximize the profits, the lowest, the costs per se, as we experienced in the past. But I think there would be I just wondering how far, how strong the central bank can go because there's a zero fiscal space, right? After COVID. I mean, US, for example, is a 15% of budget deficits in the past 2 years, more than that. And everybody is a peak. So the only thing you can do is you can print the money. So between the tight and easy monetary policy, I think the central banks really have a tough job to do. But my sense is they probably will continue sort of kick the can around the road and keep the liquidity because everyone needs the money. In that sense, inflation will remain pretty high. I don't think inflation will coming down, right?
I agree with you. I'm glad you mentioned that last point, which is, there's various dimensions of security, but one of the things I think we're going to see pretty much everywhere is diversification, this by countries and by companies. And the reason for it is that, we live in a different world. When you and I were younger, and I was a lot younger, we lived in a global economy that very rarely shut down, right? Sometimes we had supply shocks and violent price movements, but, basically you didn't get in. And then you fast forward to today, you've got climate shocks, increasing frequency and severity. You have global tensions, interfering with the openness of markets. You've got now this conflict, and you had the pandemic, which was a major shock, And I don't think most people think that's the only one we'll ever have. And so you have rising risk with respect to your supply and demand chains, and they're uncorrelated. And, you know, when we teach our students finance, as you do, in Tsinghua, we tell them that when you have rising uncorrelated risks, the proper response is diversification. And that's relative to the world of lower risk, that's going to be expensive and add to inflationary pressures. Exactly what you said.
Yeah, this is also raises another interesting issue because diversification means increasing cost on the corporate,
Exactly.
right? So corporate side really have a big three in the categories of cost increase, labor cost increase, input material cost increase, and diversification cost increase. So they will either push the price increase or squeeze the profit margin, right?
Right.
So, which on the very fundamental base, the productivity can slow down and the growth will further slow down, right? By your theory.
Yeah, unless you know, I mean, I think there is some productivity growth potential, as I said before, but, you know, in the short run, yes, absolutely right. So far, the limited evidence that I've been able to pick up suggests that most corporations have the ability to pass on the price increases. Some of them aren't passing them all on. You know, I have friends in the, you know, mutual friends with you in the supply chain world who say that some of the major players are absorbing some of the costs right now. So inflation, looked at from the point of view of final prices, is actually higher in the kind of on the cost side than what's showing up in the marketplace for the final product. But that's just more inflation, right? But in the long run, they'll pass it on.
Right. But the risk is pretty high, and particularly with the volatilities. But these are all in the real sectors. But when we move to the financial sector, you also teach finance, you know, and in both Milan and in NYU. Do you expect to see a big financial market adjustments? I mean, given anytime I seek the real economy financial market, right? I see the real economy is changing, adjust, but rather in a slow pace because more or less things moving, you know, okay in the sense, right? I mean, the three costs increase, but it takes time. But the financial assets increase dramatically because quantitative easy monetary policy, right? And interest is close to zero, and net return in many assets is close to zero. Do you see financial market will experience a big adjustments in the near term because inflation pressures and because the monetary policy change and because there's a geopolitical risk?
I do. I mean, I don't know how to calibrate it, but it'll feel very different from, you know, the kind of liquidity fueled central bank dependent, you know, asset pricing that they've seen in the past. I just don't see that continuing. So, and generally, I think when you have a period of inflationary, you know, higher inflation, that there is a tendency for the asset markets to underperform relative to their long-term averages. So, yeah, and less liquidity. I think we'll see less liquidity events. And when you look around the world, the thing you mentioned before, which is higher sovereign debt levels, in lots of places, that's going to produce distress of a variety of kinds. And your colleagues in Washington at the IMF are going to be in the center of trying to deal with, you know, some debt restructuring and whatnot in a range of economies that have been forced to get themselves into trouble, I guess, because of the pandemic.
On the sovereign debt issues, in the past few years, almost 10 years now, particularly since 2008, the global financial crisis, right? The public debts piled up, increased dramatically. But the interest payments actually rather slow down, right, in terms of share for GDP, because zero interest in the policy, right? So if the real interest rates change, I mean, nominal interest rates will change quite a bit. do you see a big debt crisis happening or it's coming?
I'm not really sure, man. I mean, the way you get out of a debt overhang, you and I both know, is with nominal growth, right? So, and you get nominal growth from the sum of real growth and inflation. Right. So, maybe a period of inflation, which is otherwise not terribly desirable, will actually help reduce the kind of real liability of some of these sovereign debt overhangs. So I don't know how to, calibrate that at the moment, because there's sort of pluses and minuses, but.
Your theory, based on Lewis' 20 points, actually have a huge implications on globalization. Mm-hmm. Do you think globalization will slow down? I mean, from different angles. Trump was anti-globalization, but whatever, right? I don't see economic, foundation and serious support, his political positions. But if the whole world, turn into the new regime, does that mean what that impact on globalization?
So I don't think this shift is necessarily, a negative with respect to globalization. I mean, it depends on what you call deglobalization. I think diversification will feel a little bit like deglobalization in some dimensions. Mm-hmm. But having sort of, supply constraints be more binding and feel more binding than they have in the past, I don't think points us to deglobalization. I think when I think of deglobalization, I think of downside risks of really, intercepting and disrupting, global flows of technology, for example. In meeting the sustainability crisis, one absolute prerequisite is that, technology, wherever it's developed, flows freely and openly to wherever it's needed, which is everywhere in the world, right? So the worrying parts of deglobalization, I think are associated with tensions and policy shifts that really disrupt global flows. Mm-hmm. I mean, the patterns will change for sure. I mean, they already have, Min. If you go back, four decades, the purchasing power in the developing world wasn't all that high, right? So trade consisted of commodity flows into developing countries and, goods flows out. Well, that's no longer true, right? I mean, there's a huge amount of purchasing power in the emerging economies now. So, trade, some trade is internal. I mean, China absorbs a fair amount of what it produces because it's such an enormous economy now. That's a completely different pattern than way back when. So just the evolution of the global economy as emerging economies grow and achieve their growth and development objectives will produce changes in patterns, and they're not worrying. I mean, they take some navigational skills, and maybe one of the big changes is this, reduction in the relative size of underutilized productive capacity relative to demand that we were talking about before. But still, you can still have a relatively open global economy if the major players are determined to keep it open. So I think when there's risks there, regardless of which side they come from, I mean, the risks are policies that are a reflection of some kind of deep underappreciation of the importance of the global economy in terms of prosperity for everybody. And so I think, just a determined effort to make sure that we don't go down the road of having, sort of economies functioning in silos or spheres of influence is a kind of pretty high priority for the major economies in the world to lead, major countries in the world to lead.
Wow, this is a fascinating conversation. We booked 30 minutes. We ran over times already, as usual. And this is absolutely amazing. Anytime when I talk to you, it's a joy because you always bring in this very deep fundamental thoughts with us. It's really, really nice. I mean, today you bring us a very big picture, regime shift, right? The whole world experience lowest turning point shifting. And so then we are moving from cheap labor-driven growth model to more productivity-driven growth model now, which we're moving from demand-constrained growth to supply-constrained growth. So the policy also need a shift to more supply-side structural reform and also structural reform as well. I think that's a very, very important point. And also during the process, and obviously the inflation pressure will be high, so the management process will not be easy, and managing the smooth transitions also will not be easy. But this transformation not necessarily against the globalization, right? But it's also just say, as this process, we need more global cooperation, global leaders working together and make sure the whole world will be moved into a new regime, still maintain strong productivity growth and growth, so that will be good for the whole world. And the current political interruptions and no good, and we particularly need to be careful on the inflation risk and the central bank's monetary policy risk as well. I think this is really, really fascinating. Thank you once again. Do you have any last words you would like to add?
No, I mean, I think, that good people in a whole variety of countries who understand, the importance of this, will be influential in the long run. I think China has voiced its leading policymakers, have voiced their commitment to some modified, adapted version of multilateralism. I'm hoping the United States takes the same view, although there's some risk there. We are polarized, and there's a subset of our policymaking apparatus that doesn't seem to be focused primarily on that. But I try to be, I try to remain a cautious optimist.
That's good. It's a beautifully end this conversation. Once again, thank you, Michael. Thank you so much. Bring your insight, share your thought with us. It's a really, really joy. It's so thoughtful. Thank you very much. And also, I would like to take this opportunity to thank everyone online to join these sessions, and warmly welcome once again. And thank you. Take time off to join these sessions. And I hope you had the same feeling I had. We learned a great deal. So let's hold together our hands. Big hands for Professor Michael Spence. Thank you, Michael, very much.
Thank you, Min. Thank you for having me.
刚才朱院长和 Spence 先生呢，在
Just now, Mr. Zhu and Mr. Spencer discussed about many key points about the global growth, the dynamic for the global economic growth, as well as several issues concerning the financial markets. And Mr. Zhu summarized it very well. So once again, I would like to thank them for the insights. Now the floor is given to Xian Zhengmin. Distinguished guests from both online and offline, Mr. Zhu, Professor Michael Spence, good morning. It gives me great pleasure to participate in the Tsinghua PBCSF Global Financial Forum. The topic of this meeting, of this session, is global financial economic governance and financial open cooperation and opening up. And we're faced with many challenges in terms of the global economic governance and financial cooperation. I would like to make a brief presentation. The title of my presentation is to promote the leverage of multilateralism First of all, G20 has promoted development of global economic and financial governance. In the fall of 2008, at a critical juncture of the international financial crisis, G20 was escalated from ministerial meeting to state-head summit. And in November 2008, the first meeting was held in Washington. April 2009, the second G20 summit was held in London. The 11th was held in September 2016 in Hangzhou. In the previous summits, the leaders of G20 have reached a series of important consensus about responding international financial crisis and upholding the global economic stability. So the summit has promoted the recovery and development of global economy and played a significant role, along with the mitigation of global financial crisis. The focus of G20 global economic or financial governance has turned to long and medium-term reform. Under the promotion of G20, FSF was renamed as FSB. The members have extended to 20 countries and regions and international organizations. So it has become an organization for international standards making and has made many extensively impact suggestions for financial system reform and financial governance standards. Meanwhile, Basel Committee has extended its membership as well, including the BRICS countries, and China is among one of them, and other emerging economies. The multilateralism and representation have all been improved. With the promotion of the G20 mechanism, Basel Committee have undergone extensive reform on the banking regulation, international governance, including the too big to fail issue. There are additional regulations targeting the too big to fail issue. The systemic financial risk prevention have become more effective. Ever since the outbreak of the COVID-19, the global economy was once suspended with volatility in the market. However, the global financial system have undergone the challenges. After all, no significant crisis was taken place. It has undergone stress tests under the reality scenarios. This has shown that with the joint efforts of the leaders from G20, the soundness of global financial system have been improved significantly. Reviewing the past 10 more years, the G20 mechanism was born in crisis and has undergone the roles of stability provider and reformer. G20 is a mechanism that is born with along with globalization and the support of multilateralism. The member states of G20 should uphold and operate this mechanism. With the globalization as the backdrop, countries have been interdependent. If we look back into the past 20 years, G20 have been playing major roles in stabilizing the orders. G20 is a mechanism that has been born along with globalization. It promotes globalization and supports multilateralism. In the years that G20 has been playing its roles, we have witnessed the most smooth era between China and the US in cooperating on the economic and financial fronts. Both sides have shown calm and professionalism and have deepened the communication and cooperation in bilateral and multilateral economic and financial issues. Now, global economic and financial governance systems are faced with great challenges. With globalization as the backdrop, countries have been more interdependent on each other. However, in recent years, we have been seeing the inequalities and social contradictions. And there have been signs of counter-globalization in 2016. With winners Brexit, and Trump was elected as the president of the United States. That was two landmarking incidents. With that backdrop, some countries were having trade and economic frictions with each other. And we are seeing the weaponizing of interdependency. In recent years, the global geopolitical situation is getting more and more tense. The sanctions by several countries have triggered new impacts to the global economic and financial system and exacerbated the high inflation as well as the tension in the supply chain and shortages of food. The third country's people are faced with the worst impacts. Meanwhile, developed economies' monetary policies are being adjusted in a faster speed. And this again trigger the debt stress and debt burden of those highly indebted countries. Henry Farrell and Edward Newman, two academics in 2019, published a thesis about the weaponizing of interdependency. If you're interested, you can go and download this thesis. The two experts are from Johns Hopkins and Georgetown universities. Thirdly, China will adhere to opening up and multilateralism. China have been deeply integrated into global financial and economic system. Ever since then, China has been the agent and power in the promoting of globalization and the stabilizing of global economy. Since the financial crisis, China launched in fast speed a series of economic stimulation to improve the recovery of global economy. On January 17th, President Xi Jinping in 2022's World Economic Forum mentioned that China will unswervingly promote reform and opening up. No matter what happens in the international front, China will uphold the flag of reform and opening up. In the complicated international environment, we shall face the deglobalization and anti-multilateralism. China will unswervingly deepen reform and expand high-level and high-quality opening up and promote marketization, legalization, and international development to promote the dual circulation and provide our contribution to the global economy. Thank you very much. Thank you very much for Mr. Xuan's insights about multilateralism. Now the floor is given to Mr. Zhang Yuyan, Director, Institute of World Economics and Politics, Chinese Academy of Social Sciences. Thank you very much, Wei Dong. It gives me great great pleasure to be invited to the 2022 Tsinghua PBCSF Global Financial Forum. I listened to the high-end dialogue between Mr. Zhu Min and Professor Michael Spence about the global economy. I also listened carefully to Director Xuan Changneng's global financial governance. I'm very much inspired. Now, in the next 10 minutes, I would like to touch upon the logic of global economic governance, which is in line with the theme of this session. The issues of the global economies are as follows. Ultimately, we must maintain a strong, sustainable, inclusive, and balanced growth. The source of the growth are the following three. Technology advance, as mentioned by Mr. Zhu Min and Professor Michael Spence. The improvement of productivity. If we want productivity to be improved, the technology advancement is the key, as well as the trade revenues. If there is no technology advance, we could still accumulate the wealth and simulate the wealth growth by having more revenues from trade. And that is from the theory of Adam Smith. Products are exchanged between countries, even though there are no technology advances. You could still distribute labors and exchange products in order to gain trade exchanges. The third source is more fundamental and more basic. Be it technology advance or trade revenue, they all require a system to pinpoint them. For example, if you manufacture clothing and you produce agricultural products, when there are no trades, then nobody would gain anything. So there should be system guarantee. That brings me to the third point. So those are the 3 points. So what is actually the global economic governance? It is closely correlated with the economic activities of the mankind. It was born with the gap of the world's governments. So without the governments, state entities or state actors or non-state actors have come together to create such a system to satisfy the interest of each other. So it's a self-disciplinary rules. Basel Committee, as mentioned by Mr. Xuan. So different actors have sit down by themselves to come up with a series of rules and frameworks. A broad range are included: trade and investment, supply, value chain, commodity supplies, as well as financial system and the monetary system, climate change and low carbon, as well as anti-terrorism. The problem now are a huge amount of governance deficit. When President Xi visited Europe, he mentioned several times about the 4 deficits: peace deficit, development deficit, governance deficit, and trust deficit. Without the governments of the world, there are still problems to solve, such as pollutions, climate change, instabilities in trades. So how to deal with all these problems? There are deficits, and we must resolve them. We have common interests to deal with all these deficits. But it is necessary for us to act collectively.
Now, governance actually requires cost, and how is the cost to be shared, especially together with the returns? So that is the dilemma of collective governance. Some people want to be freeloaders, but others refuse for you to be the freeloaders. So here is the exclusivity. Because once one product is created, why should I let others benefit from it? And then there's the self-discipline based rules. There are neutral rules, which means applies to everybody, treating everybody equally, everybody benefits from this. And then there are non-neutral rules, meaning different people benefit from that to different extents. Now, in that case, some countries might want to squeeze others or crack down others for maximization of their own interest. So that is the power politics by the major economies. Now, one example that to illustrate, Larry Summers, actually Paul Samuelson in 2004 in Economics Outlook published a well-known article arguing the following. Just like I said in the beginning, trade can be mutually beneficial as an important source of growth of productivity. Ricardo Muller actually disregarded the progress of productivity. So that theory can be feasible without regarding these, but otherwise it cannot stand. For instance, two countries producing food and clothing. Now, the conditions are they have different productivities, and then there's a comparative advantage, so they can trade with each other to advance their own welfare. So that is the Ricardo Muller model for trade. That is the basic, most fundamental model. But once you take into account the technological progress, so the productivity was different in these two different countries, but technological progress makes it possible that because of the openness of trade, will be realized because of this openness. And then the productivity will be the same between these two countries. So the trade benefits will no longer apply, and that actually can kill the trade between such two countries because of the benefits are no longer there between from one country to another. So this actually applies to what happened between China and the U.S. For instance, in China, one sector's productivity can benefit from the technological progress. Therefore, at the cost of one sector from the United States. So that is the conclusion by Paul Samuelson in his article. So basically, trade globalization can be both beneficial and costing at the same time. I was really surprised by his article and argument specifically, because I thought economists like him would be actually supportive of a trade globalization. Now, this might connotate the factor of power politics of the bigger economies. So trade should be open to benefit the whole of the global economy. Now, the governance structure and regime should have a standard for coverage, or should it? Now, there are regional arrangements, but there is no such a global arrangement. And how can we define the boundaries for the coverage of global governance? Now, here I listed two. One is the trade benefits, the other being the size of the market. Once the bigger the size, the more the expansion of the market, and hence the regional and global governance. Of course, there is a cost of governance comes into play, and how you make your arrangements. There's Basel 1, 2, 3, and the documents become thicker and thicker, over 6,000 pages for Basel 3. Now, one thing I want to point out, the power politics of the bigger economies. Now, just as Samuelson pointed out, when power politics comes into play, there are other factors involved, geopolitics and the ways to get more power, because thereafter, difference or advantage over all of you guys. So that means they want inflict something onto others, and then that is the disparity comes into play, and that is actually zero sum. Oh, that is more than just zero sum. It's actually negative gain. So the logic is therefore completely changed. So again, the factor of power politics of the greater powers. I will not go into details. Of course, there are traditions, conventions, and cultural, and the difference of paradigms in thinking. The United States now, as we can see, is stressing the importance of like-mindedness. The U.S. is trying to align itself with so-called like-minded countries. Now, about openness, since we've been talking about financial sector's openness, now, is openness a positive term, or does it have any negative connotations? Is the externality always positive, or there are negatives? And then how can we gauge openness? We've been working with our partners in developing a openness report of the world. So we established a openness index. One basic idea we argue is it has to be appropriate. The openness has to be appropriate, suitable to your own local context or realities. At the same time, security is becoming increasingly a concern for countries of the world in the context of openness. Security versus openness. For instance, people or the cyclists are increasingly worried about the effectiveness of brakes. Do the cyclist, or does the cyclist want to go faster or slower? And only when the cyclist wants to go fast does he or she be worried about the effectiveness of the brakes. Of course, there is the internalization of the RMB, and in interest of time, I'll skip that. And now here we come to the challenges for global economic governance. Now, the sanctions on to Russia by the United States touches on the fundamental issues of the global economic governance, especially that actually has to do with the foreign reserves of the United States. Now, all in all, we need to find the most suitable pathway for China to become more open. Now, so much for my remarks. Thank you. Thank you. Now, the global governance for global economy and the framework and the boundaries, the extent, limits, and very inspiring. Thank you, DG Zhang. And now I'd like to give the floor to Mr. Xue Lan, Dean of Swartz College of Tsinghua University, who will be joining us online. Now you have the floor. Take it away. Well, thank you, moderator. I want to thank the organizer, PBCSF, for the invitation. Now I feel very inspired by the previous speakers. I want to share my screen first, the slides that I have. Can you see my slides? Now, my presentation is about the competition between China and the US vis-a-vis innovation. Now, my presentation might be outlier, but that's what I thought. But based on what I just heard, I think my viewpoints are quite in line with what the previous speakers said, just like Professor Zhu Min and Professor Spence talked about the declining supply of cheap labor. So how can we balance that? Innovation was pointed out, mentioned by them. Now, I was actually in New York. I talked to Professor Graham Allison and Professor Spence about innovation. So that will be what I speak around the U.S.-China cooperation and how can we govern that. So 4 parts: introduction, to be followed by the broader context, and thirdly, framework, proposition, and then to my audience, since my slides are in English, I will be speaking actually Chinese. Now, just like Professor Zhu Min and Professor Spence said, innovation is increasingly a major driver for economic growth, and the competition in this regard has also intensified. China has come a long way in innovation. Kennedy School of Government of Harvard has a famous professor, Graham Allison, and they did a report named The Great Tech Rivalry, China versus the US, in which article the idea was proposed: the tech rise of China challenges US dominance in technology. And this has been paid a lot of attention by the Americans. Now, as the competition continues between the two countries, if governed well, everybody can benefit from innovation-related innovation, just as Professor Zhu Min and Professor Spence said. But on the other hand, negative impact can also be a possibility with terrible consequences. Now, what happened between China and the US in tech competition? Now, first of all, China has made rapid progress in science and technology over the past 4 decades. We are on par with the U.S. international science publications, and we are in the lead in international engineering and publications and patent applications and grants. As Graham Allison said in his article, in the most cutting-edge foundational technologies, China is becoming a serious competitor for the U.S., especially in AI, quantum computing, 5G, semiconductors, biotechnology, and green technology. You can refer to their report, of course. Now, China's progress is made with institutional reform in China. Of course, this can be debated by others. China has done rounds of reform as well as enhancement of collaboration internationally. Now, there are a few graphs I'd like to share. Now, this one here is about the tech collaboration of China. So you see the upward trend, and then the licensing fee paid, and the red line is China. Now we're only behind the US. So the technological progress made in China is really a benefit or dividend reaped as a result of reform and opening up. Now the capabilities of innovation in China are still lagging in many areas. For instance, studies or literatures internationally have described China as very powerful. However, we still have weaknesses. Now, in terms of publications, a number of publications, China is leading, but top 1 percentile publication citation, there is still a big gap. Here is the US and here is China, so you see the gap there. Now, the key technologies, for instance, semiconductor, China has a yearly trade deficit for semiconductors, and now China cannot import what it wants to import in semiconductors or the high-end chips. And there are still areas desiring more progress in the key technologies. So are we friends or foes or competitors between China and the US? Now, China has been working with the United States following the start of reform and opening up. Of course, in recent years, we are more of competitors, and some in the US now regard China as foes or enemies, just as Mr. Xuan said, the so-called negative-sum power politics from the export control, from the investment review and the entity lists, as well as the control or the vetting against or on the Chinese background scientists. So all of these are restricting the exchange between China and the US in the area of technology. Now we talked about the negative some power politics. Because of the achievement accomplished before, China now faces time to make a bigger contribution, be it knowledge building, build up of know-how, or the creation of new products.
I have some numbers for you to refer to in the global innovation, and the related issues. The limitations from the U.S. are not doing any good for everybody. The U.S.-China collaboration in bio and medical science joint papers. From the left-hand chart, the blue curve is the total number of the publications. Red indicates China's. But if you look at the cooperation between the two countries, U.S. takes 10%, Chinese 12%. So it's relatively high percentage, but in different fields. For example, in mechanical engineering, two countries' cooperation takes 30% of all the publications in the U.S. And in artificial intelligence, very high as well, 58% in all the publications. So in other words, China and the U.S. have extensive cooperation in high technologies. Therefore, the limitation to these cooperations are against the interest of both countries. So how to effectively manage the competition between the U.S. and China technologies? It is a reality. There is a basic framework in the U.S.-China technology field with two dimensions. One dimension is the advance of technology will enhance defense capabilities. Another dimension is the enhancing of economic prosperity. So technology is benefiting national defense. The first dimension have the assumption that it is good for national defense, but has no benefits to economic prosperity when export control is in place, as well as other limitations. When the cooperation is enhancing economic prosperity, and we're seeing the regulation from WTO and TRIPS on commercial technologies. But Q3 is unclear now. It might benefit both national defense and economic prosperity. There are many uncertainties when it comes to AI. So this is a field that is frequently discussed. How to manage this effectively? We've seen research from many academics. This is a thesis published last year. It is divided into two dimensions. Risk going upwards, the risk grows. Going downwards, the risk will decrease. And the other dimension is the social revenues or the benefits to the society. In actual practice, there are many difficulties. With the backdrop of U.S.-China rivalry, President Biden has been limiting the U.S.-China cooperation in technologies. These measures are not in the interest of both countries, so we should have better management. With that in mind, what can be done next stage? First of all, we should open channels of communications on multiple levels, dialogues between governments, parliaments, and think tanks. From 2010 to 2016, I participated in the innovative dialogue between U.S. and China. They were about the issues in the field of US-China technology rivalries, and we try to find solutions through dialogues and competitions. These dialogues were quite necessary. However, they are no longer available. Second point is to adopt a framework to manage technology rivalry between the two countries. We already touched upon this point. The third point is to establish boundaries for competition. Try our utmost best to minimize negative externalities to the global community. Try to minimize negative impact on global value chain. As we all know, the global value chain is touched upon by Professor Michael Spence. The resilience of the global value chain should be improved. And to mitigate the geopolitical crisis so that the global value chain will be less impacted. Another point is to adopt measures to reduce distrust and regain confidence, such as climate change and public health. There have been many cooperations. Such cooperations should be enhanced to ensure more collaborations in research in climate change, public health, and so on. We should also prevent the misuse of artificial intelligence and other emerging technologies. Given the improper management, huge risk would be triggered. There must be effective ways for global governance for AI and other emerging technologies. This is to share responsibilities for China and the US as the two biggest economies. And that concludes my presentation. Thank you. Just now, Dean Mr. Xue touched upon the analysis framework of US-China tech rivalry and cooperation. I believe they're of great importance. Thank you again, Mr. Xue. Once again, I would like to appreciate all the panelists, and that concludes session 4